All right. Hi, everyone. Welcome to this new Analyze Your Trade event, number 214, for Tuesday, October 29th. And I have 16 great analysts lined up for you to analyze your trades and share some of their trade ideas with you. So we're going to try this new half-hour format. And so I think this will be a really interesting, like lightning round type version of the Analyze Your Trade series. So today, to open the event for us, we have Dan Passarelli of MarketTaker.com. So I'm going to go ahead and turn it over to him.
All right. All right. All right. All right. Let me get my video on here. Hi, folks. Dan Passarelli here. Little background on me. I'm with Market Taker Mentoring, which is the global leader in option trader education. And we are going to be talking about charts today. Now, as far as talking about charts, I think you can see my screen. And I imagine you can hear me. Otherwise, somebody would be telling me you can't hear me. So let's take a look at, and David, what I go till 9:30, right? Or,
Yes.
yeah,
Yeah, 9:30 Central. Yeah.
yeah, okay. Depending on what time zone you're in.
Yeah.
So, there's a number of things that we've been concerning ourselves with lately, and the importance of them changes as time passes. One, of course, is, the Fed interest rates, which is basically caring a lot about inflation rates, as well as the potential for rates not falling fast enough and putting us into recession. And that's still on the radar. And then we came into earnings because earnings week started a couple of weeks ago, and the market has been trading off earnings a fair amount. But now we're 1 week until the US presidential election, and people are trading off that. And, just a couple of things as far as the election goes. I think that one really key thing to look at as far as trading the election is look at the likelihood of who may win and what policies they may put into place, and select stocks based on fundamental information based off that criteria. Now, that's pretty hard to do because emotions get in the way of trading. And you might love this one and hate that one and think the world's going to end if that one gets in, and everything's going to be, unicorns jumping over rainbows if the other one gets in. And that can affect your trading, whether that's picking stocks based on who you think, not feel might win, but think might win, or just for the market as a whole. So we want to be really conscious of that and take all the emotion out of our trading. So one key way that I do that is to just trade the same way I always do and stick to a technical evaluation of stocks and get a little help, cheat a little bit, if you will. So one of the things that I do for that is I built a couple of scanners here. This is Credit Spread Genius. And the gist of it is anytime a professional trader somewhere in the world makes a large credit spread trade, I and my subscribers get to see it. And so here it is. Earlier today, at 9:41 and 42.816 seconds Eastern time, somebody sold 592 of the 3M regular December, so third Friday December expiration, 135, 145 call credit spreads at $1.63. So now, just because a professional trader made this trade doesn't mean that it's necessarily the best trade in the world. So we need to analyze it ourselves. I use these, it's just to get trade ideas. So let's move this out of the way here. And I know that if I'm selling the 135 calls and buying the 145 calls, if I were to make this trade, I would have to have a reason on this chart to believe that between now and the third Friday of December, 3M is likely to stay below $135 a share. And I do have reason to believe that. First of all, the 50-day moving average ends up being a support or resistance level. Here, because the stock is below it, it's a resistance level. So that gives me one little extra thing in a likelihood of the stock staying below 135, because there is some increased likelihood of it staying below 132.96. We also have the 21-day moving average, which is not nearly as strong as an indicator as the 50-day moving average when it comes to support or resistance. But notably, we have the 21-day moving average about to cross below the 50-day moving average, which would be a bearish signal, which would be good for a negative delta trade like this. The next thing is we do see at this point resistance. It was support here, but when support is violated, it becomes resistance. And we had this strong support level here, and it was actually a resistance level here. So this $133 level has been a key pivot point for a while. And if we go up to 135, one could argue that we see that even more clearly as a pivot level. So I actually like this trade. I like putting this trade on and holding that through the election. Okay, so that's credit spreads. And we've only gotten one of those today. I built a couple other scanners. And one of them is for wing spreads, which are butterflies and condors, including the iron version. So this is a put butterfly in this stack, SEDG. Here, someone sold the 13, 17 and a half, 20 put butterfly at 22 cents. So this is sort of an interesting one. We don't see a lot of short butterflies. Let's see what this would look like from a profit and loss diagram standpoint. So if I go to SEDG and I pull up my options, I pull up my options and I narrow this in a little bit. Regular November, so that's the 17-day ones, which is the second one after the election. No, we need to expand this a little bit more here. Hold on. All the way down to 13. Geez Louise. So here someone is selling this one, which they would typically be buying, and then buying two of these, and then selling one of these. Now, the problem with this is the markets are a little bit wider than I like to see when I'm trading these. They're not terrible, but I do like to see a little bit more liquidity. So we've got a risk profile that looks kind of like this. Now, notably, when they traded this, they sold this at 22 cents. Ours is coming up at well, we would say 4 under. So actually buying or selling this, but we'd be paying out, 2, 3, 4 cents. Which is not ideal, because when we have an unbalanced butterfly like this one, and I say unbalanced because there's $4.50 between the guts and the low, strike wing, but only $2.50 between the guts and the upside wing. So we end up with something a little bit lopsided like this. This is actually a pretty darn interesting trade. The more we collect, the more above break even this bottom part is. And probably to some degree, we don't care that much. All we're looking for is, and this stock right now, by the way, is at, is right at that gut strikes, 1752 it's at. Get this thing out of the way here. Okay. So basically what this person is looking for this to do is, this person thinks that this stock is going to move over the next 17 days. If it moves to the downside, this person just doesn't really want to lose money. Or excuse me, to the upside, this person really just doesn't want to lose money. But if it moves to the downside, it appears that that's what this person thinks this is going to do. And he or she probably did this, to tell you the truth, because they wanted a put debit spread, but they wanted to get rid of the upside risk. Because if they just bought the 17.5 puts and sold the 20 puts, they'd be paying more for this. And if the stock went up, they would be in losing territory. But here, the way they put it on, 22-cent credit, they were able to basically finance the cost of that put debit spread, which is actually kind of a clever trade, isn't it? Now, the other wing spread that we saw here is in NVIDIA. And that's a balanced long call butterfly, which is a more normal, this is a more normal and straightforward trade. Except there's one thing that's not really normal and straightforward. And this would require somebody who has some experience trading these. When it wouldn't help if it would help if you had some experience reading these as well, but that you probably don't have unless you're one of our subscribers. So this person bought 165, 175, 185 call butterfly at 63 cents with the stock at 140. This is a really interesting trade. And it's a really smart trade, because for those of you who have some experience with butterflies, if somebody buys the 165, 175, 185 call butterfly, first of all, where do you want the stock to be around expiration? Well, the answer to that is you always want it to be at or around the middle strike. But look, the stock is at 140, 140.18 specifically when this person put the trade on. So they need the stock to go up like $35, which is like 20 something percent. Why would they do something crazy like that? Well, it's probably a little bit of a lottery ticket trade, but the nature of lottery ticket trades is it's very low cost, so low risk, but very, very high reward. And that's just what we get. Because I have a question for you. How much can this butterfly be worth? Who can tell me that? Hit that chat box. How much can a butterfly like this actually be worth? Anybody? Well, is it too early for you too? It's kind of too early for me too. I'm on the Pacific Coast today. So it's 7 o'clock. Oh my gosh. And I had a late flight getting in. So 10 times, yeah, well, right. G, you're basically right. It can be worth $10. It's can be worth anywhere between its maximum price is either the wings, subtract that to or from the guts. So 175 minus 65 is 10, or 185 minus 175 is 10. It can be worth $10. So this person is paying 64 cents, risking 64 to make a profit of 936. That's an extremely small amount of risk. That's single digit percents, 8% or something like that. So, but does this trade make sense from a chart standpoint? Well, let's take a look at that too. And notice I'm not thinking, oh my God, who's going to win the election? My person that is sent from, the options gods down to me to shine upon me, or the other person who is terrible. I don't have those emotions creeping in here. I just look and see what someone's trading, model it out, and see if the trade makes sense. So we're going to have to go like this, put on the filter. You also get a little crash course in Thinkorswim if you're not up to speed on that just yet. And this is December. So this person is giving him or herself plenty of time. December has 52 days from now. So when we trade a butterfly, what we do is a traditional butterfly where we're buying it, we buy the 165 calls, sell 2 of the 175 calls. Oops. And then, oh, geez. And then buy 1 of the 185 calls. And we get something that looks kind of like this. So the stock is around here. Let's do this. The stock is right here where this yellow dotted line is. And so if the trade doesn't work out on a 10 lot, the most I can lose is $630. But if I don't get movement to the upside between now and then, I would manage my risk. I would sell the spread and take some profit on it, or cut my losses on it, I guess I should say. But if I'm right, or if this trader here is right, and I follow along, if we get up into this area, we're risking $610. We can make, over $9,000. Now, this stock is unlikely to be exactly at 175. So I always like to dial back those pie in the sky, look at how much reward potential there is. $9,390, I think, would be at the peak. So I always like to say, okay, here's the top, here's the break even. I would say if it's somewhere halfway between, not just having there, it was somewhere halfway between the break even and this and the top. So that puts me right around here, the middle of that range. So basically, realistically, as long as I'm between, say, like 170 and 180, I'd make about $5,000. I'd make, before I said 10 times, and realistically, that's exactly correct. So risking 1 to make 10. And that's what I love about trading these, is that all these trades originate from professional traders. I mean, wouldn't you like to see what professional traders are trading every day? If not to copy their trades, to learn from their trades. Because, 250 contracts here, I mean, that comes out to, well, here, let's change this to a 250 lot. Most trader stands to lose $15,000 maximum. Now, again, this person's smart enough to manage his or her risk, is they're not going to lose 15 grand. And they stand to make, again, between the top and the break even is like here. So between 170 and 180, they stand to make 100 grand. It's pretty good risk reward if you're pretty bullish on NVIDIA. Now, I just flew out here. We're in Henderson, Nevada, visiting my mother. And I was in Chicago O'Hare Airport at the United Club talking to somebody. And, we're just shooting the breeze. And he's like, oh, so what do you do for a living? And I tell him options, and he just gets this grin on his face. And he's like, oh, yeah, here, tell me if I got this right. And it's like, okay, it was kind of, a lot of people like, you get done with work and you just want to leave it at the office. Well, first of all, that's hard when you work from home like I do. And second of all, I don't really look at this as work. I look at it as something I'm passionate about. So I didn't mind giving them a free lesson on how call options work. But man, I'll tell you what, if my flight was delayed and so was his, and I was able to pull up this chart at the airport, I would say this is a way better trade if you're bullish on NVIDIA, because he actually brought up, hey, I'm bullish on NVIDIA. Should I buy calls? It's like, how am I, and give you free lessons, but not free advice. But had I had my chart open and we were talking about NVIDIA, I would have asked him, well, what's your price target? Oh, well, about 175, anywhere between 170 and 180 between now and December expiration. Okay. Well, I mean, if you just buy a call, let's say a December call, it's going to cost you $2.34 or something like that, $200 per contract. Here, you're only risking 62 cents. You're risking a small fraction, risking 30% of what you would if you just bought the call. And if you buy the 175 calls, your break even is 177 and a half. Realistically, you would have to buy at least the 170 calls, but then your break even is 173. You'd probably have to buy the 165 calls so that your break even is below 170. And that's going to cost you a whole bunch more. That's going to cost you $390 per contract instead of 61 cents per contract. So had I had my charts open in the airport and, had more time, I would have shown him this trade and his freaking head would have exploded, because this is such a better trade than just going in and buying a call. Interesting stuff, right? Now I'm going to show you one more, because this is a pretty traditional version of the butterfly. And bear with me 1 second here. Bear with me 1 second here. Okay, just had a message from my man Bobby. The final one I want to look at here is in Boeing. So we all know that their planes fall apart in the middle of the sky and their workers are on strike and their bond just got rated to junk. So let's take a look at a chart of Boeing. We'll get rid of this trade, although I kind of love this trade a little bit. Kind of love this trade a little bit. You know what I'm going to do? A lot of times when I'm doing these seminars, I wait until I'm off the call to make the trade, but this one's just too good to pass up. Oh, what did this person pay for this originally? 64 cents. So yeah, if I can buy it at 65 cents, I'm just as happy with it. You know, now it's ticking down. I'm going to try and steal it at 64 cents. There we go. And I just traded it nice and small. That's about a $350 trade. Under that, $300 trade. So worst case scenario, I lose probably 150 bucks. Best case scenario, well, I guess 635 bucks. Best case scenario, I make about $4,000 on it. From a risk reward standpoint, that's beautiful. Beautiful. All right. I think I have time for one more. 5 minutes remaining. Okay, great. Hey, by the way, if you find this interesting, I do have a strategy guide that kind of explains credit spread. Credit spreads. And I just put a link to it in the chat. Oops, I think I just sent it to the hosts and panelists. I should send that to everyone. Oh, thanks, David. Appreciate it. Okay. So this trade, well, better be quick about it. Be really quick about it. In Boeing, somebody is buying the 140, 150, 160, 170 Iron Condor. Now with an Iron Condor, oh, somebody's probably, I don't know, somebody's selling this one. Yeah, okay, so that's normal. So they think that that Boeing's going to be between 150 and 160 over the next 17 days. It's at 152.25 right now. So I mean, after the stock has gotten beaten up so badly from, this is just a 6-month chart, high of about 195 to being down here at about 153. They're looking for it to be in this range, and that's not really that unreasonable. So we would sell the 140. Here, I'll show you. I got time. Yeah, I got time. So maybe selling the 140, 150 put credit spread, and then the 160, 170 call credit spread. Oh, I just screwed that up. Sorry, folks. Down to 150. Wait a minute. Hold on a second.
Hey Dan,
Yeah.
sorry, I gotta
Yep. All right. Well, you guys get the idea. All right. Hey, thanks for sharing your time with me. Hope that strategy guide helps. And David, thank you very much for inviting me on.